The AICPA recently released a new valuation and accounting guide for the valuation of portfolio company investments of venture capital and private equity funds and other investment companies. That title is a mouthful, so going forward, we'll just say the guide. The guide was developed by a team of industry experts and was designed to harmonize the diverse views of industry participants, auditors, and valuation specialists. In this video, we'll be going over some common terms you may find in the guide, the first of which is called the unit of account. Before we begin, let's make sure we understand the concept of fair value. The Financial Accounting Standards Board, or FASB's, authoritative guidance on fair value is contained in FASB Topic 820, which states that the objective of a fair value measurement is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between market participants at the measurement date under current market conditions. In other words, fair value means what something is worth on a specific date. Now that we've covered the concept of fair value, let's discuss the unit of account and how it impacts fair value. As many private equity and venture capital funds invest in multiple tranches of a portfolio company's securities, you need to determine whether the unit of account is worth more as a grouping of such investments or the individual security tranches. FASB Topic 820 tells us that a reporting entity shall measure the fair value of an asset or a liability using the assumptions that market participants would use in pricing the asset or liability, assuming that market participants act in their economic best interest. Simply, is it in a market participant's best interest to sell their assets individually, as a grouping, or a mix between the two? Let's walk through a simple example with two fictitious companies, the Parker Fund and the Arkham Company. Assume the Parker Fund invests in the common stock, preferred stock, and mezzanine debt of the Arkham Company. If the securities could be sold individually for $50, $30, and $20 respectively, but could be sold together for $110, the FASB guidance would tell us that the unit of account is the bundle of all three securities, as opposed to the securities individually, and that our fair value measurement would be based on one unit of account and would result in a fair value measurement of $110. This is because selling the bundle of securities would yield the result that is in the economic best interest of the seller. Alternatively, if the value of the bundles sold together was $90, then it would be in the economic best interest of the seller to sell the three individual securities separately. So you would state the fair value of each position separately, and you would have three units of account. One important thing to keep in mind is that the unit of account contains a grouping of assets. Then the fund's schedule of investment should indicate the total fair value estimate with an allocation of fair value to each security. This should be done in a reasonable and consistent way. For instance, in the previous example, if the Parker Fund determined the relative fair value of the $110 was $60 for common stock, $30 for preferred stock, and $20 for mezzanine debt, it would show the fair value on their schedule of investments as follows. The other important factor here is that the unit of account is only relevant to the reporting entity or the fund, so you can't consider the grouping of assets and liabilities outside of the reporting entity for the purposes of estimating and reporting fair value. Let's look at another example with two more fictitious companies, the Stark Fund and the McFly Fund. Let's assume that the Stark Fund invests in the common stock and preferred stock of Arkham Company, while the McFly Fund invests in Arkham's mezzanine debt. If the securities were sold individually by the funds that own them, they would yield $50 for the common stock, $30 for the preferred stock, and $20 for the mezzanine debt. Assume if we grouped the common and preferred stock, they could be sold for $85, while the mezzanine debt could be sold for $20. The fair value measurement of the Stark Fund for its investments in Arkham Company would be $85 with 1 unit of account consisting of the common and preferred stock together. The fair value measurement of the investment in the mezzanine debt of Arkham Company by the McFly Fund would be $20 with 1 unit of account. The key here is that the Stark Fund cannot take the mezzanine debt into consideration when determining their unit of account. And similarly, the McFly Fund cannot consider the common or preferred stock. The next important element we need to understand is what's known as the time horizon. When an investment company initially makes an investment into the debt or equity of a private company, it considers the expected cash flows it will receive over a set period of time through the ultimate exit from the investment. That period is known as the time horizon. For the purposes of determining fair value at different measurement dates, market participants would typically consider the cash flows for the investment under current ownership through a liquidity event and the market participants' required rate of return, consistent with the economic best interest of the investors who in aggregate have control of the business. Accordingly, while FASB Topic 820 contemplates a transaction at the measurement date in determining the assumptions that market participants would use to value these investments on the measurement date, it would be appropriate to include the time horizon that market participants would expect for the investment, the strategies available to maximize value for the investment, and liquidity considerations. Let's take a look at another example. The Parker Fund purchased its investment in the Arkham Company on January 1st, 2018 for $100 and was estimating the fair value of the investment at December 31st, 2018. The Parker Fund projected on January 1st, 2018 that the realizable proceeds on the investment at the end of the 4-year time horizon would be $180. This projected estimate was based on earnings multiples of comparable companies on January 1st, 2018. If we move to December 31st, 2019, the fund is now estimating what it could sell the security for at that time, assuming that the time horizon is now 2 years and the earnings multiples on comparable companies have decreased by half, resulting in expected realizable proceeds of $90. So in this example, would you estimate the fair value at December 31st, 2019 as $180 or $90? The answer is $90. Remember that the objective of a fair value measurement is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between market participants at the measurement date under current market conditions. In other words, how much is the asset or liability worth today? The time horizon is important because it illustrates that investments are made with an anticipated hold period, and that hold period should be considered in how it impacts fair value. But remember, this does not eliminate the need to consider what another market participant would pay for the asset in light of the holding period on a measurement date prior to the end of the time horizon for the investment. These other market participant considerations may include many other factors, including company-specific performance, competitor performance, and current market conditions. Thank you for watching. The full guide can be found on the AICPA's website. KPMG is here to help you with any questions you have about the guide, and we look forward to the opportunity to talk about how the guide may impact your business.